What is up, everybody? Welcome back to the Stocktrades YouTube channel. My name is Dan Kent, one of the co-founders of Stocktrades.ca, and in this week's video, I'm going to be going over something that is in very high demand right now, and that is semiconductors, particularly semiconductor ETFs. I'm going to give my very brief outlook and opinion on the semiconductor industry, and then I'm going to go over 3 ETFs, one of them right here in Canada, that you can own to gain exposure to the industry without having to pick an individual stock, which at current valuations, picking the wrong horse in the race could get you in quite a bit of trouble. So with that being said, let's dive right into the video. We're going to be discussing 3 semiconductor ETFs. Let's go. All right, everybody, before we start, remember, smash that like button, head down below, subscribe to the channel. Let us know what you think of the video, and let me know what you want to see next. Let me know if you own any of these semiconductor stocks or ETFs. Now, this was in very high demand discussing these stocks, obviously with them going to the absolute moon the last while, so much so that I did have to write a piece over on Stocktrades that discusses semiconductor ETFs. Now, this is a fairly brief post that discusses 3 of the ETFs in the video that we'll go over today, which are CHPS, SOXX, and XSD. The 3 ETFs we're going to be discussing in this video, but I know that some people would want me to comment on Nvidia and the current absolute ballooning that it's done the last while, so I will speak on that. Now, when we look at Nvidia, in my opinion, buying at these price points, you have a company that is worth nearly $1 trillion market cap, and as we can see on a valuation basis, it is trading at 38 times trailing sales. This is absolutely absurd. To be honest, it would be very hard for a company that is already worth $1 trillion to grow to an extent where a 38 times sales multiple is justified. I mean, we saw a company like Shopify trade at a 40 to 50 times sales multiple for a very long time, but Shopify was nowhere near the size Nvidia is right now. You can't really explain a bullish enough thesis to me to justify paying 38 times sales for a company that is worth $1 trillion. If you're buying Nvidia right now, you're virtually betting on the fact that this company will be the most impactful company and the most successful company on the planet moving forward by a landslide. We can see that it's also trading at 207 times trailing earnings, which obviously there is supposed to be quite a bit of growth for Nvidia moving forward. We can see that on a forward basis, it's only trading at around 41 times earnings, which again, for $1 trillion company, that is a very expensive valuation. It gets difficult when you hit that size to grow a significant amount relative to a company with a smaller market cap. Now, I know, again, I'm going to face a lot of heat in the comments for, the people who are absurdly bullish on semiconductors, AI, all that things like that. But again, looking at this logically, I see very little ways that Nvidia could justify this valuation. And when we look to a forward basis, it is trading at 19.5 times forward sales. This company has a historical average of around 15.75 times sales on a trailing basis over the last 5 years, and it goes down to around 11.2 on a 10-year basis. What has happened now to justify a near 4x of its 10-year historical averages in terms of price to sales? It seems unfathomable, to be honest, that the company would all of a sudden be worth 4 times what it has historically been worth over the last decade based on events that have come to fruition in the last 6 months. Again, these premiums exist practically everywhere. I mean, price to earnings, TTM earnings of 207 compared to 62 over the last 5 years and 42 over the last 10 years. We're looking at a price to free cash flow of 194 times. That is nuts. 10-year average of 41.4. And that is why when we look to this price activity here over the short term, I mean, you're talking from the mid 200s to nearly $400 a share in very short order. So if you really want my overall opinion on Nvidia, I don't think anyone buying at these price levels is ever going to have a strong long-term annual return from a purchase right now. I'm actually pretty stunned that a lot of investors didn't learn their lesson in 2020, 2021, 2022, when we saw all these bubbles show up and eventually burst. I obviously don't want anybody to lose money in the markets, but I just don't ever see how paying nearly 40 times sales and 200 times earnings for a company of the size of Nvidia will ever come to fruition and produce long-term returns. Now, that said, a lot of people still want exposure to the semiconductor industry. But if you are like me, you might think that Nvidia is way too expensive. It's gone up way too much the last while. You might be looking at semiconductor ETFs. These 3 ETFs I'm going to go over today will give you exposure to the entire sector without betting on the wrong horse per se and leaving yourself with some poor returns if you do end up picking the wrong company. So the first ETF I'm going to go over is the Canadian one, and it is from Horizons. It trades under the ticker CHPS.TO, and it's a relatively new fund. We can see here that the fund came into existence in 2021, approximately late June 2021. It got off to a pretty hot start, but as the bear market hit, as the overall market bubble popped at the end of 2021, it saw a significant drawdown in its price. At the bottom, this fund was trading around 35% lower than its initial price that it got to market with. And now we can see, since that October low, it's rebounded quite a bit, and it's actually up 8% since inception. Now, the fund has assets under management of $50 million. This is going to be much, much less than the other 2 funds I'm going to talk about. And just because it's a Canadian fund, they're not as popular as the US counterparts. We have a much smaller market compared to the United States. So 50 million in AUM, but it is a fund that is growing in AUM, and I don't really expect this fund to go anywhere. It's going to stick around, especially with the popularity of semiconductors. Now, it has an expense ratio of 0.55. You're going to pay $5.50 every single year for every $1,000 you have invested with this fund. It's a niche ETF. I would actually consider this fee pretty reasonable, considering the fact that, many niche ETFs in Canada, let's say a REIT ETF, even something like a Canadian listed ETF that gets you exposure to the United States, the fees are typically higher. And I really don't think this is that bad to get you one-click exposure to companies in the semiconductor sector. Dividend yield, negligible, 0.68. You're not going to be investing in this for the passive income stream. You're going to be investing in it for the total returns when it comes to the semiconductor sector. And when we go to allocations, we can see that chips is primarily located in North America. We have about 66% exposure to the United States, but we can also see that it does have exposure to the Netherlands, very small exposure to Germany, and obviously developing markets in Asia with 12% to Taiwan. And you're going to see what company that is in the holdings. But this is very much a play on the US semiconductor sector, but it is also the semiconductor ETF in this video that has the least exposure to the United States. So we're looking at around 47% giant companies in terms of market cap, 41% large caps, and then we have around 10% to mid caps and very small amount to small cap companies. These are all large semiconductor producers. So when we go to the overall holdings, we're going to see Nvidia Corp at the top. It has around a 13% allocation. And we're going to see Broadcom as the second holding, which was our semiconductor play over in one of our model portfolios at Stocktrades Premium. It's up something like 50% this year. Not as absurd as Nvidia. It doesn't have as much exposure to the AI space, things like that. But Broadcom is an outstanding producer that has had some crazy dividend growth over the last while. So we put it in a income model portfolio over at Premium, which, by the way, link in the description, 14-day free trial, no credit card required. We have ASML Holdings, and this is the Taiwanese exposure, would be Taiwan Semiconductor. They're one of the larger semiconductor manufacturers in the world. Texas Instruments is one of my favorite companies in the United States in terms of exposure to the sector. We can see that this ETF has relatively concentrated exposure. We're looking at 14, 9, 23, 31, 40, around 45% of this whole ETF is allocated to these top 5 holdings. And when we look to the total holdings in the portfolio, there's around 56 companies. So there is decent exposure to a multitude of semiconductor companies. So that's pretty much it for CHPS. It trades in Canadian dollars, and Horizons is an outstanding fund producer. So this isn't a bad option for those who are looking to keep their money in CAD, but they want to get exposure to the industry. Now, the one thing I will note, although this is probably a very small issue for most, possibly a negligible issue, but maybe you might have not known about this before, because this is a Canadian listed ETF that has US listed stocks. If they pay a dividend, even in an RSP, you will be subject to withholding tax on those dividends. So, with a 0.68 yield, this doesn't really mean much with this fund. But if you're looking at other income funds, Canadian listed income funds that hold US stocks, something to consider. So the next ETF I want to go over is SOXX. I'm not sure if anybody else calls it that. That's what I call it. It's the iShares Semiconductor ETF. It trades under the ticker SOXX. And as you can see, this fund has been around for a very long time. In fact, its inception was right after the dot-com bust, as we can see in 2001. And for a very long time, as we can see here, this fund traded relatively flat. You're talking for 14 plus years. It didn't really return that much. And then in 2015, I mean, semiconductor technology overall just exploded. And as we can see here, the fund, the compounded returns, if you were to have bought this in, say, 2015 up until now, would have just been massive. I mean, we can span this out to a 10-year chart, and you're looking at 760%. So some quick comparisons to Horizons CHPS if you are considering Canadian versus US holdings. Look at the size of this. It's much larger, 8.3 billion in AUM. I think when I wrote the article over on Stocktrades, and I wrote the article like 2 weeks ago, this had 7 billion in AUM. So you can just see the sheer volume that is being dumped into these AI-based stocks and AI-based ETFs right now. So I did mention the larger the fund, typically the less fees it charges. And obviously with the US market being so much bigger, fees will tend to come in lower. We're looking at 0.35%, so around $350 per thousand invested. You'll pay that every year. At a dividend yield, again, negligible, 0.81%. However, the difference here being, as I mentioned in the last ETF, you will not pay 15% withholding tax owning this ETF inside of an RSP, because it is a US listed ETF with US stocks. There is a difference. So the fund generally will invest at least 80% of its assets in component securities of the index, and it could use up to 20% of its assets in certain futures, options, and swap contracts. So let's go to allocations here. And when we look here, we can see that CHPS was around 60-some%. This is 87%. So this is a lot more North American exposure than something like CHPS. And when we look to European, we can see that CHPS was around 12% of the Netherlands. This is around 7%. And when we look to the developing markets in Asia, 4.71% to Taiwan. And you're going to see in the holdings of this, it's because it contains lower exposure to Taiwan semiconductors. This also has less mega cap exposure and a bit more mid cap exposure. So something to consider as well. When we look to the holdings of the fund, we can see the top end of things looks much the same. Nvidia, Broadcom, AMD, Texas Instruments. When we look down here, this is one of the core differences. Taiwan Semiconductors, 3.55% rather than, double that allocation, I think, in CHPS. And when we look to the total holdings in this fund, we're seeing about 36 total. These other holdings will be, the 20% of assets it sets aside for things like swap contracts, futures, options, thing like that. So 30 stocks in this portfolio. And despite this having less stocks, it is less concentrated on the top end of things. We're seeing, 20, 28, 35, around 41% versus 45%. So not that much. It's still pretty concentrated in the top end plays. So overall, a bit of things to consider with this fund relative to CHPS, Canadian dollars. We're looking at, the different structure of overall holdings, more exposure to the North American market here rather than CHPS, which is a bit more international. Lower fees on this fund for considering the fact that you actually have to exchange currencies. Just overall a longer standing fund with a big history of providing positive returns, especially post 2015. So the final fund I want to go over is from SPDR, and it trades under the ticker XSD in the United States. This isn't necessarily an equal weighted fund, but it does contain a lot more equal weight strategy relative to the other funds, and the fact that it doesn't have huge double-digit exposure to the mega cap players, the large players in the sector. So it generally invests substantially all, but at least 80% of its total assets in the securities comprising the index, which is the S&P Semiconductor Select Industry Index. So the index represents the semiconductor segment of the S&P Total Market Index. So this fund has been around not as long as SOXX, and again, didn't really start gaining popularity until, post 2015, and then just absolutely exploded. 10-year returns of 714%. When we look to AUM, much smaller than SOXX. 1.4 billion in assets under management, not even close. Fees, the same, $3.50 per thousand invested. Dividend, again, negligible. You're not buying these for the income, you're buying them for the total growth and overall exposure to the semiconductor industry. So, allocations. This is even more North America focused than SOXX and CHPS. It contains 93% exposure to North American semiconductor companies, all in the United States. Next to no exposure in Europe, just the Netherlands, and even smaller exposure to Taiwan than SOXX. But it takes a unique approach to it. Again, as I mentioned, it doesn't contain all those mega cap companies. And we go down here, we see giant market cap exposure, only 8%. CHPS was, 40%, and I think SOXX was quite similar. This contains a lot more small cap and micro cap exposure. Actually, small caps are the bulk of this ETF's total holdings. That is very likely why you see the dividend being half of that of SOXX. This is something everybody needs to consider when they look at this fund. It is a small cap semiconductor fund. When we take that into consideration, we have to acknowledge the fact that it is likely to be more volatile and is likely to pose more risk reward, I would guess, but we'll check the total returns of all three of these ETFs in just a second. When we look to the holdings, we can see that Nvidia is still the number one holding, but it's only around 4.66%. This is not even close to the other two ETFs. And we see companies that are not as well known. I mean, when we look to Rambus Inc., they have a market cap of only $7 billion. They aren't a small cap company, but they're a mid cap company. And actually, if we look at this price action, this would have been a small cap company, even as early as the start of 2023. That is how much this sector has exploded in popularity. Even if we go to the valuation of this company, 133 times earnings, 15 times sales, 35 times cash flow. So it's not just Nvidia that is trading at pretty rich valuations. Moving back to these holdings, we can see AMD, they're still in here. Marvell Technologies, Broadcom, little smaller exposure than anything else. The one thing we don't see in the top 25 holdings here is Taiwan Semiconductor. Now, I would imagine it is still in here. I can only see the top 25 holdings, but it is obviously with the 2% exposure to Taiwan. It's a smaller exposure than you would see in the other funds. So again, with 39 total holdings and the top holding weighing 4.66, this is more of an equal weight fund, even though that's not its strategy at all. That's just kind of the way it works here. It's more equal weighted with, the number one holding being 4.6 and the 25th holding being 2.4. And it's more exposed to small cap companies. Now, how has this worked out historically? And if we go to the fundamental chart here, we'll change this to total return. And we will type in SOXX. We'll compare the two US-based ETFs first. Over the last year, relatively similar performance. iShares has outperformed it by around 75 basis points. And if we go to long-term returns, they're actually so close it's pretty crazy, especially considering the difference in holdings makeup. You're talking since 2006, around a 6% difference in returns. You know, the similarities of these returns, especially considering the different makeups, is actually pretty surprising. Overall, though, when we look to annualized data, I mean, these are some crazy annualized returns over that amount of time. It's all come in the last while, though. If we look to 10-year returns, we're talking 24% annualized. 5 years, it's about the same, around 21, 22%. 3 years, it increases, especially with the boom over the last while, 26%. These funds are probably going to have a very hard time putting up these annualized returns over the long haul. That's why I would caution people investing in semiconductor ETFs right now. Valuations are really rich. This was a video I made primarily based off demand. I'm going to show people the potential options, but I overall think these ETFs, these funds, these stocks are significantly overvalued right now. If you want to invest in them, and this is obviously just my opinion, I would take caution. We could see a significant valuation reset if the industry doesn't prove to be as big of a boom as many are saying. We've seen plenty of these bubbles over the last few years. I mean, we saw it with plant-based foods, very good food beyond meat. They've now gotten absolutely butchered, down 95%. We've seen it with renewable energy stocks. You know, they absolutely skyrocketed in, I think it was 2020, and now they're, still in a drawdown almost 3 years later. Work from home-based companies, we've witnessed Shopify take a significant decline just because of brick and mortar businesses moving there during the pandemic. They were selling things on Shopify, but once the economy opened back up, the company saw a massive drawdown in terms of overall price. Other payment processors in Canada, such as Lightspeed, Nuvei, stuff like that, they went through a significant drawdown as well. To me, this is all signs of a significant bubble, investor hype. I just don't see valuations withstanding this over the long term. But I really hope you did like this video. If you want to consider ETFs as an option, do so at your own risk. I'm happy to show you the options, but I wouldn't necessarily suggest buying them. But again, you're free to do with what you wish. These valuations could stay unjustifiably high for years. We've saw it before. Bubbles don't necessarily have to pop immediately. They can take a very long time to do so. There's a very popular saying, the market can stay irrational much longer than you can stay solvent. And this is actually one of the primary reasons that I am not short a company like Nvidia, despite thinking that valuations are absolutely absurd. I know a lot of people have asked if I've considered taking a short position, and it has been on my mind, but I still haven't executed that, primarily because of that exact mindset in the market. This could go on for years, and valuations could get even higher. We could see these ETFs and individual stocks cruise from here for the next few years, but overall, I just don't think they're good long-term buys at this price, and I figured I'd give my opinion on it. If you appreciate the opinion, head down below, smash that like button, subscribe to the channel, and most importantly, claim your 14-day free trial, no credit card information required, to Stocktrades Premium, and I can provide even more in-depth commentary on these semiconductor stocks and ETFs inside of our Discord. So we'll see you next time.